this year we had a very strong year. I mean, if you look at last year, the U.S. didn't experience a pullback any greater than 7%. So markets are definitely not cheap this year. We're trading above our 5-year average. That being said, when you look at the Treasury, only at 1.7%, stocks on a dividend basis are still yielding more. I think we have some legs, but at our firm, we're being a little bit cautious. And instead of going full-blown into the index, we think it's time in the U.S. to start being more selective and go back to being an individual stock picker, finding those names that are trading at a discount to their average and are actually projected to grow faster than what the S&P is.
Okay, so looking for names that are at a discount, do you also want to rotate out of some names that have just perhaps had this incredible run? We think of some of the big tech names.
Yeah, I think so. I mean, I think some of the tech names are getting a little bit stretched, but I think more importantly, if you look at some of the names like the utility names, if you look at some of the real estate investment trusts, the quote-unquote safe havens where people have rushed for yield, those are some of the stocks that are actually the most overvalued, where technology, quite honestly, really isn't that inexpensive, and in our screens, we're finding some of the greatest value there still.
And if you have to be more selective, do you drift towards the financials then? Because we spoke about how this week is going to be largely driven by financial earnings, and if the Fed doesn't move lower on rates, stays in pause mode, then that would be margin accretive for the financials going forward from here. Now, I don't know how much is the promise of outperformance from these levels, because some of these stocks have already run up, but is there potential?
Yeah, I don't know. I'm a little bit discouraged. When you look at interest rates, right, I think interest rates are going to stay lower for longer. That means that net interest margin, which traditionally is what banks are able to profit from, that gap between borrowing and lending, is not going to be that wide. So I think that actually creates a headwind for the financials. But what we're doing, if you look at the S&P 500, you're essentially trading about 10% above the 5-year average. If you look at the growth, that's expected to be about 10%. So instead of 10 and 10, our narrative is 20 and 20. We're looking at stocks that are going to grow at 20% plus and are trading at a 20% discount to their 5-year average. And in there, again, like I said, we're finding some technology names. Palo Alto Networks, a cybersecurity name, that's one that's projected to grow 24 to 25%, trading at a discount of about 20% to its 5-year average. And when you look at a company like ServiceNow, this is one we're really excited about. Great balance sheet, $1.5 billion in cash on the balance sheet. It's going to grow at 30%. And this is a company essentially that's taking laborious manual processes, digitizing them in a streamlined atmosphere with companies like Salesforce and Microsoft. That's a company that still a lot of people are not talking about that we think has a tremendous amount of upside.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.